Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about McCormick & Company Incorporated quarterly report. McCormick & Company Incorporated offers a diverse range of products and services to the food industry. In its consumer segment, the company provides spices, herbs, seasonings, condiments, sauces, and desserts under various brand names such as McCormick, French's, Frank's Red Hot, Lawry's, Kahlua Hot Sauce, Clubhouse, Gourmet Garden, and Old Bay. These products are marketed in different regions of the world, including the Americas, Europe, the Middle East, Africa, and Asia/Pacific. In addition to its branded products, McCormick & Company also supplies its products under private labels to retailers such as grocery stores, mass merchandise stores, warehouse clubs, discount stores, drug stores, and e-commerce retailers. The company's Flavor Solutions segment offers a range of products including seasoning blends, spices and herbs, condiments, coating systems, and compound flavors to multinational food manufacturers and food service customers. The company serves its customers directly or indirectly through distributors, wholesale food service suppliers, and e-commerce platforms. McCormick & Company was founded in 1889 and is headquartered in Hunt Valley, Maryland. Its extensive product portfolio and global reach make it a leading player in the food industry. McCormick & Company Incorporated market capitalization of $14 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that McCormick & Company Incorporated holds a significant advantage in their industry. McCormick & Company Incorporated trades at a lower price-to-earnings ratio of 8 times and a higher price-to-book ratio of 1.96 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 56% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 3.78%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth for a company can be attributed to several key factors. The acquisition of McCormick de Mexico has contributed significantly to revenue growth, with varying percentages reported across different summaries. Favorable pricing and foreign currency rates have also played a crucial role in driving revenue upwards. On the other hand, revenue decline is often caused by unfavorable volume and product mix, which can range from -0.7% to -1%. Tariffs have also had an impact on commodity costs, leading to decreased revenue. Increased competition from alternative channels and changes in consumer preference and demand have further contributed to revenue decline. Supply chain disruptions due to natural disasters or public health crises have also been a significant factor in revenue decline. These disruptions can lead to shortages of essential products, resulting in lost sales and revenue. Overall, the company's revenue growth and decline are influenced by a complex interplay of factors, including acquisitions, pricing, currency rates, competition, consumer preferences, and supply chain disruptions. The company's financial performance underwent significant changes between 2025 and 2026. Net income experienced a substantial increase of $859 million, or 524%. Rising from $163.4 million to $1,022.3 million. This growth can be attributed to the gain from remeasuring the previously held 50% ownership interest in McCormick de Mexico, which contributed $866.8 million to the net income. However, profit margins did not follow a similar trend. The gross profit margin saw a slight increase of 0.3%, rising from 37.5% to 37.8%. On the other hand, the operating income margin experienced a decline of 1.9%, dropping from 14% to 12.1%. This decrease can be attributed to special charges and increased costs that negatively impacted the company's operating performance. The company's financial performance indicates a fluctuation in its ability to generate positive operating cash flow. In 2025, the company successfully generated $430 million in positive operating cash flow, demonstrating a strong financial position. However, this trend was not sustained in 2026, where the company reported a decrease to $390 million, indicating a slight decline in its ability to generate positive operating cash flow. The company's debt level has undergone significant changes over the past year. Short-term borrowings have increased substantially from $381.4 million to $1,309.9 million, indicating a substantial rise in short-term liabilities. On the other hand, long-term debt has also seen an increase, albeit smaller, rising from $3,105.8 million to $3,604.1 million. The total debt level has also increased from $39.6 million to $62.4 million. In contrast to the significant changes in debt levels, interest expenses have remained relatively stable. Despite a slight decrease of 2.5% from February 28, 2025 to February 28, 2026, there is no indication that interest expenses have changed significantly over the past year. The performance of various segments and regions has been analyzed, revealing both successes and areas for improvement. Within the consumer segment, which overall performed well, the Americas region and EMEA region stood out as top performers. These regions demonstrated strong growth and met expectations. In contrast, the APAC region struggled, failing to meet projected targets. Despite this setback, the consumer segment's overall success highlights its resilience and adaptability in a competitive market. Management is optimistic about the company's outlook and strategy. The acquisition of McCormick de Mexico is a key part of this plan, as it creates opportunities for growth in the Mexican market and provides a platform for expansion in Latin America. This move is expected to make significant contributions to the company's 2026 outlook, driving long-term profitable growth through prioritized investments in key categories. The company anticipates strong sales growth in 2026, with net sales projected to increase by 13–17% due to favorable volume and product mix, pricing, and the acquisition of McCormick de Mexico. Adjusted operating income is also expected to rise by 60–20%. The acquisition has already had a positive impact on gross profit margin, adding 12.4% to net sales. To sustain this growth, management is focused on cost savings through various initiatives, investing in technology to drive growth, and prioritizing organic growth with a 0.5% increase in sales across all regions. Additionally, the company aims to offset inflationary pressures by increasing prices and improving efficiency, while also driving revenue growth through pricing, productivity improvements, and supply chain optimization. Overall, management is confident in the company's ability to achieve its goals and drive long-term profitable growth through a combination of strategic acquisitions, cost savings initiatives, and investments in technology and organic growth. The company has made several significant acquisitions and divestitures in recent times. In terms of acquisitions, the company acquired a controlling interest in McCormick de Mexico, further solidified its ownership with an additional 25% stake from Grupo Herdez, and entered into a proposed transaction with Unilever Foods. However, it's worth noting that this proposed transaction is contingent on the separation of Unilever Foods' business prior to closing. Furthermore, governmental authorities may require the divestiture of certain businesses or assets as a condition for completing the deal. These divestitures are intended to ensure compliance with regulatory requirements and facilitate a smooth transition. The company has a history of returning value to its shareholders through both dividend payments and share buybacks. In recent years, the company has paid out significant amounts in dividends, with totals reaching $128.9 million in 2026 and $120.7 million in 2025. Furthermore, the company has also engaged in share buyback activities, repurchasing a total of 154,000 shares in 2026 for $10.9 billion. The company's commitment to returning value to its shareholders is evident through its dividend payments and share buybacks. The anticipated quarterly dividends for at least the next 12 months suggest that this trend will continue into the future. Additionally, the fact that these activities are being conducted under existing authorization indicates a deliberate strategy to return value to shareholders. Concerns about inventory buildup and supply chain disruption are valid based on recent data. The company's finished products inventory has seen a significant increase of $36.3 million, while raw materials and work-in-process inventory have risen by $58.2 million. This accumulation of inventory may indicate potential issues with demand or production efficiency. Furthermore, the company is facing challenges in its supply chain due to fluctuations in the cost and availability of raw and packaging materials. Global energy supplies are being disrupted, leading to increased input costs and strain on the supply chain. These disruptions have been exacerbated by inflationary pressures, making it difficult for the company to maintain a stable procurement process. That concludes the financial summary for McCormick & Company Incorporated. Feel free to comment below, and I will be happy to answer them when possible.